Hey folks, and welcome back to another video. If this is your first time with us, my name is Alex. I'm that Hawaiian guy helping you folks out there in YouTube land build a stronger and safer portfolio. In today's video, we're going to talk about the topic of the stock market just going down, down a little bit more. What should you be doing? Should you be selling? Should you be buying more on the dip? Should you be buying bonds? Or should you sell your entire portfolio and get out of the market altogether? That's what we're going to talk about in today's video, and hopefully by the end of this video you might have a better understanding of what you can do to be proactive to make sure your portfolio is safe for future investments. Without any further ado, let's get right into it. Alright folks, here we go again. Another Monday effect. We've talked about this quite a few times on this channel. What typically on a Friday evening or over the weekend, that's Saturday and Sunday, you see things that happen in the news and in social media where that Monday morning you see a huge dip in the market in particular sectors. However, today you might be noticing more than just a dip in a particular sector. You might be noticing a dip all around the board. Now, I kind of saw a lot of long-term investors out there screaming to the public, hey, you should empty your portfolio and buy into bonds, and I was quite surprised. Typically where bond prices are today, the individuals who have been in the market long enough to understand how things are working would actually advise individuals to sell their stock portfolio and buy into bonds. Well, I can't tell you what to do. I personally would not want a 10-year bond at 1.9 or 1.2%. That's just me personally. Even in the worst year, typically in the stock market, like I've said many times, you're going to gain at least a 7%. Even though we are seeing a huge decline today, as I'm watching this video, July 19th, 2021, we are seeing about a 2% decline all around the board. But for the most part, you're still going to do far better in the market over time in the long run. Now, with the resurgence of the pandemic, with I think what are we on, like number 3 now, number 4 with the Delta variants, you're seeing the market just kind of tumble from Wall Street all the way over to Tokyo, all around the world. You're seeing a quite decline in the market. Prior to making this video, the S&P 500, they fell about 2.1%, which is quite of a contrast to maybe 2 weeks ago. They were selling at record highs. So in a way, you're not really seeing a huge dip in the market, but perhaps just a little correction, because we have seen phenomenal growth over the last 4 or 5 quarters. The Dow Jones average is down about 935 points, or about 2.7%. Also, the NASDAQ is a little bit, maybe about 1.3, 1.4%, a little bit lower. So you see, it is not just a particular sector as far as the finance or oil and gas or minerals or financials or those type. It's not one particular sector that's seeing a decline. It's kind of a decline all over the border. And again, we're coming off a record growth for the last 3 or 4 quarters, so it's really not a crash in the market again. It's just a little correction going on. I actually kind of dug a little deeper and I was looking at the European market, and the European market actually saw about a 2.5%, and then the Asian market, and I'm referring to China, Korea, and Japan, they dropped a little bit more, about 2.6 to 2.7. So it's not just a US thing, it's not just a Canadian thing, it's kind of a world thing that's going on right now. And a lot of this has to do with our favorite buddy, the Corona virus. You guys know what it is. I try not to say the name too much because YouTube don't like it when you say the name of that particular issue that's going on in the world right now. But you know what I'm referring to. And as this resurgence starting to pick up, particularly I'm talking about areas in the US where I think the last time I saw about 51% of the US citizens were double vaccinated. But you're still seeing an increase in a lot of areas in the US. Here in Canada, where I think we're sitting about a 56 to 57% double vaccination rate, so we are a little bit better or a little bit higher vaccinated than the US, but both of us are kind of sitting at that 50% range. One of the great things about Canada is that majority of the individuals here do see vaccination as something that will benefit themselves as well as the country. So it's not as much of a pushback here in Canada, where a lot of individuals don't want the vaccine. The majority of individuals here actually do want it and are very eager to get their first. Most of them have the first to get that second vaccination. And when you look at places like I was looking at a report about Los Angeles, where the mask mandate has come off and people are getting back in droves and just getting back to norm like things were a year and a half ago. You're seeing a high spike in the cases in that particular area of the country, because people are just becoming very nonchalant. I'm like, yo, I've been indoors for the last year and a half. I'm done with this. I'm over. I want to get out and have a good time. And I hate to use those harsh words like you're being careless and kind of unsensitive to other individuals, but you're just prolonging the problem that is currently going on, and it's not going to really get any better if a good part of the individuals in certain sectors around the world that access to the vaccine just say, hey, I don't want it, I don't believe in it, it's all a hoax, there's really no pandemic going on. I'm not here to preach one side or the other of the aisle. I'm just saying that from an economic standpoint, this is what we're seeing, what is affecting the market today, because of a lot of individuals out there are really afraid of another surge coming on. And I don't really see us going into a complete lockdown like we were before, just because, again, half the population, at least here in North America, are double vaccinated. So we won't fall back into a complete lockdown. I don't really foresee, but I think maybe restrictions might kind of stay in place, where you might see like a hybrid version of work where maybe partial online as well as maybe partial at work. Now, I was reading an article by a financial advisor that I kind of follow a lot. I really like his work, and his name is Barry Bannister. He's a chief equity strategist out of Stifel, and what he said to the stock market might be in the early stages as much as a 10% drop over the next quarter or so. But however, you got to look at, he's saying this after the market over the last 5 or 6 quarters has almost seen a double percent increase. So even dropping 10%, if you kind of bought back, say back in March or April or May, say even you bought one of the FANG stock, let's just take Apple for instance. If you bought Apple back in say June or July, which actually I kind of started buying a little bit heavy, because my ecosystem in my home, almost everything I have here, my computer, my laptop, my cell phone, my vehicle, I use Apple products. My watch, I like Apple products. So even though back then it was trading about, I want to say $85, $90 a share, I bought maybe 50 or 60 shares of Apple back then when they were trading about $90. And even though maybe about 2 weeks ago, Apple got up to about $148 per share, and then this morning I checked, they were down about 142, which is about a 2% decline. Sorry, a lot of numbers there. But even though there is a 2% decline from $148 to $142, keep in mind, I bought the stock back when it was $85, $90 a share. So even if Apple dropped to 120, say it lost, 10, 15, even 20% of its value, I'm still ahead from where we were back in 2020, because this is just how much the stock market has actually grown over the last year to year and a half. So please don't look at this as another crash in the market like we had in the pandemic back in March of 2020, because you are coming off of record highs for the last 5 or 6 quarters. So this might just be more of a correction, and a big part of it is more just to individuals that are worried about this third variant that's coming out, and just too many skeptical individuals out there thinking that the coronavirus, I said that word, I'll bleep it out, that this virus is a hoax. But another kind of culprit to the decline in the market, I was actually reading in an article a couple of days ago, is fading pandemic relief, which the U.S. as well as the Canadian government has been giving out, helping those individuals in need. You're starting to see a little bit of pullback into some of these programs out there that's set up to help individuals who've been highly affected by the pandemic. You're starting to see quite a bit of a pullback in some of those programs that are kind of coming to their end. Now, today what I did is I just looked at a broad stroke of what's going on in the market, and kind of what I calculate is about 95% of the market is just down. It doesn't matter if you're talking about the minerals or the consumers or those non-cyclical type stocks. It's down across the board, which is why you really do need a diverse portfolio. And like I've said many times before, typically I like to stay at least 60% of my portfolio to those non-cyclical type stocks. And you have the non-cyclical and the cyclical, and those non-cyclical type stocks, they will do quite well. It doesn't matter what the market is going through. And those are companies like McDonald's or Walmart or Target or Home Depot, those kind of staples that you need to survive. It doesn't matter what's going on in the world. Whereas those cyclical stocks are like tech kind of things that you buy when you have more money in your bank account. So those cyclical type companies really depend on how much the consumers out there have to spend. Versus those non-cyclicals, they're things that you just need to live from day to day. So typically my portfolio stays pretty heavy towards those non-cyclical type stocks, and you just try to diversify as much as possible. However, that being said, even those non-cyclical stocks are getting hit like crazy. What I'm trying to get across is, yes, we are seeing a little decline in the market. Yes, it has a lot to do with the current situation with the pandemic. It has a lot to do with individuals out there who believe that this pandemic is not real. I'm not here to try to persuade you one way or another, but what I am trying to tell you is, yes, there is a correction in the market. Yes, we have corrections all the time, but unless you're like 65, or unless you're like in retirement age, where you're going to retire in the next few months or so, let this ride out like it always rides out, and don't pull all your money. I can't tell you what to do. But me personally, I wouldn't pull all of my money out of the market just because we're seeing a bit of a correction in the market. Even if you look at companies like the FANG stocks, I think everybody but Netflix. And if you're not familiar with FANG, it's Facebook, Apple, Amazon, Netflix, and Google. And I think out of all of those FANG stocks, only Netflix is actually seeing a little bit of an increase today. But these are companies, if you have high conviction in these companies, I wouldn't pull my money out. Actually, I really do love Apple, so this morning I actually bought a little bit more. But that being said, don't be afraid. Don't go into this thinking, oh my God, my portfolio dropped 2 or 3%. Actually use this as a learning platform. How can you diversify your portfolio a little bit better so you are not affected as much when situations like this come around? But keep in mind, about 95.6% or so of the market is actually down today. So it doesn't really matter how much you diversified, you still got hit a little bit. So are there any companies out there that you can put in your portfolio to be more on the safe side? Again, like I said, I would stick more to the non-cyclical type companies, which might help you kind of weather the storm a bit. And some great companies that I've done phenomenal with are companies like Walmart or Target or Home Depot or Procter & Gamble, Johnson & Johnson. These are those kind of companies. It doesn't matter. You need these products. You need these companies. And traditionally, these non-cyclical stocks will do quite well. So if you do need more diversification in your portfolio, I highly would suggest you to look at some non-cyclical type companies, those companies that would do well in any market. As a side note, I think I saw Chick-fil-A was one of the companies that did quite well today. I don't know why Chick-fil-A is such a winner. I don't even like Chick-fil-A, but their company always does amazing in the stock market. I know a lot of individuals out there love Chick-fil-A, and there's a lot behind why the company might be doing so well. To be honest, I haven't done any research into Chick-fil-A because I simply don't have any interest in that company, but they always do quite well. If anybody knows, please hit me in the comments to let me know, what's up with Chick-fil-A? Why do those guys always rock starring in the stock market? They always do quite well. I would love to know. Until I see you in the next video, aloha.